So I hope you had a good July 4th weekend. In today's market update, we're going to talk about the stock market, which is continuing to do well and powered on the back of a blockbuster jobs report. We got a lot more for you as well. Let's dive into it. So my name is Will Allen with Centera Capital. We are an RIA. I've been in the industry since 1998, and we give these market updates every few weeks. If you're new to the channel, go ahead and hit the like and subscribe. Turn on your notifications. You don't want to miss an update. So today we are talking about, it's post July 4th. We're now going into the second half of the year, and it has been a wild ride in the stock market, no question about that. One of the things we wanted to look at is the rally off the bottoms in early April in the midst of the tariff chaos that took place. The first part of the recovery was just the rally off the bottom where there was a lot of panic selling that took place, and that was enough to get the market moving for a good couple of weeks. Then if you take a look there at the stretch from mid-April until the end of May, that was powered by earnings reports that were much better than expected. Going into, and these were first quarter reports companies were coming out with, and going into the quarter, expectations were profits for the S&P 500 was going to rise at 10%. Came in at 13.5%, and we highlighted the fact that it was across all industries basically that companies were putting up much better than expected numbers, and guidance for the rest of the year was much better, which a lot of the economists who were calling for a recession thought the opposite was going to be the case. Companies were going to be missing their numbers and pulling down the guidance. What we've then had in the most recent run-up, which is basically in June and the first part of July there, has been what I call the performance chase. Because a lot of institutional investors sold during the big sell-off in late March and early April. And some retail investors did too, but this was characterized by a lot of institutional investors getting out. So they've stood by and watched a really strong rally in the stock market for months, and so eventually they have to do something. And so over the last month, what you've noticed is the market has kind of steadily risen, very little volatility, and no sell-offs of any significance because money is coming right in to buy. So that is what has been happening lately. Now, add to the performance chase, last week we got a jobs report that was super strong. And so this was on the July 3rd, right before the 4th, we got June's jobs report. And expectations were that there were going to be 110,000 jobs added. And the whisper number, which is economists and analysts, what they think might actually be the new number, was as low as 50 and 60,000. They thought it was going to be a poor month for the jobs market. Well, the opposite came in. In fact, you can see there in June, 147,000 jobs created, much, much stronger than expected. And what that also did was the unemployment rate, which had been at 4.2%. It was expected to tick up to 4.3. Well, it dropped to 4.1. So that's a big gap between the 4.3 expected and the 4.1 actual. And so those were some really good numbers, but that wasn't it. That morning, we also got the most recent initial claims for unemployment insurance, which those who have watched our videos for a while know this has been our favorite chart these last couple years, because this shows when there starts to be a lot of layoffs and people have to go file for unemployment insurance. This came in for the prior week at 233,000. It was expected to be up at 245,000. The other thing that I'll point out is for the last 3 years, each summer, this number has started to tick higher. Last year, it got up to 254,000. The year before, 260,000. So the fact it's at 233 and not up at 250 or 260, that is a big, big difference. What this tells us right now is that companies just are not laying off workers. We were very happy to see that number. Now, we got one more jobs data for you, and this is job openings, okay? This also came out last week, and expectations were that job openings were going to come in at 7.3 million job openings. Well, that's not what happened. It came in at 7.77 million, okay? So we had basically 400,000 more job openings for the prior month than what had been expected. This was a real shocker to the market. So when you add all of those reports up, it gave a lot of momentum to the stock market and propelled it higher, because we've talked about for a long time, if the jobs market is solid, odds of a recession imminent is very low. And so this was exactly the news we wanted to see here in the middle of the summer. Now, one more thing before we get to rapid fire. I want to go back to the stock market. We talked about how it is continuing to do well, but I get asked the question typically when the market's at or near highs, hey, is it too late? Have I missed the rally? Well, we have a chart to answer that. What this looks at is going back to 1989 till present time. How did the S&P 500, the stock market, do if you invested at a new all-time high versus all other time periods? Look at this. At 1 year later, the new all-time high is in green. On average, the market was higher by 13.5%. At all other times, it's been higher by 11.8%, meaning you have not missed out. There is still the potential for very solid gains, and it gets even better. Look at the 3-year number, 44% gains on average if you start and go forward at a new all-time high versus 39% gains all other times, and 5 years later, 82% to 74%. So this tells you, hey, do not think you've missed out. There still is the potential to do extremely well in the years to come. All right, with that said, now let's get to rapid fire, which is a segment we like to do where we talk about a variety of different charts that I think you need to know about, and we've got a lot for you today. We're going to start off by looking at GDP growth. The Atlanta Fed has a GDP tracker. This is for the second quarter that we just completed, and they currently believe that growth is going to come in for the economy at 2.6%. Now, in the first quarter, growth was slightly negative, and that's why you had all of the recession crowd come back out thinking we're going to have a recession. The second quarter is not going to be good, especially with all the tariff uncertainty. Well, this is showing that as of right now, that is not likely to happen. 2.6% is a very good number. Anything over 2 is strong growth. 2.6, we're glad to see that. Next chart. Inflation expectations. We, in the last couple of videos, have talked about this topic of Fed Chair Jerome Powell. When's he going to cut interest rates? This has been a big political topic. We have shown the inflation numbers that have been much better than expected. The inflation rate has been coming down. But one of the things the head of the Fed, Jerome Powell, has talked about is inflation expectations, that when consumers fear that inflation is going to be high down the future, that is a problem. And this had been creeping up earlier this year when you had all the tariff concerns, got up to 3.5%, close to 4%. But look what happened. We just got the new number, and this dropped to 3.02%. Let's just call that 3%. This is where it was for most of last year. So this is yet another reason that you could take off the table for Powell to say, hey, we don't think we should be cutting rates. This gives him cover to cut, though we don't think it's going to happen in July. It definitely should happen when we get into September. Okay, next chart. This is looking at housing. We've talked about how houses are just not very affordable right now. We did a video that was very highly watched about a month ago, talking about for first-time home buyers. It's really a tough time because mortgage rates are up near 7% and housing prices are 40 and 50% higher than they were 4 or 5 years ago. Well, this chart drives this home. It looks at, in 1985, the median household income was just over $23,000 and the median home price was $83,000. So that's about just a little more than 3 times a salary. Well, take a look at where it is now. If you're millennials, it's near $75,000 right now is the household income, and a median home price $468,000. So a much, much higher multiple here. And this again explains why it's so tough right now for a lot of people to buy a house. We need to see either mortgage rates come down or home prices come down, or a combination of the two, to get housing much more affordable. Okay, next chart here. This takes a look. We know that AI and all the money a lot of tech companies are spending in this space has really powered a lot of stocks. Tech has done very, very well. That's our largest sector holding and has been for a very long time. But what we're looking at here is the percentage of firms expecting to use AI in the next 6 months. And look at how this has rocketed higher after spending a lot of time in 23 and 24 kind of going sideways. This has gone much higher of late. And listen, the market thinks that in the back half of 25, which we're there now, and 26, you're going to have a lot of productivity gains in the markets and a lot of companies' profit margins, meaning the amount of every dollar of revenue that comes through to the bottom of the bottom line in profit. That number is going to go up because of the use of AI. We want to see this. When you see this happening, you can think this is good for stock prices looking into the future. All right, brings us to our last chart here on rapid fire, and this is looking at U.S. household leverage. This is basically how much debt do consumers in the U.S. have versus their net worth. Debt, we're talking about mortgages, car loans, student loans, credit cards, etc. Net worth, we're talking about their houses, their 401ks and other stock accounts, even crypto is in there, okay? And what you'll notice when this is going up, it means that U.S. consumer is taking on more and more debt relative to their net worth. You can see back in the financial crisis, in the run-up, this started to skyrocket there, and it peaked in 08, 09, and it has been on a steady descent ever since. This is great news. In fact, right now, it's basically at its lowest level going back really to the 1970s, meaning the U.S. consumer's balance sheet is in a really good place when you take all this into consideration. And this is positive as it relates to consumer spending in the months ahead, because we know that if a consumer has a job and they have the balance sheet, they like to spend money. This chart can't get much better. So the key takeaway is that the stock market is continuing to do well. There was a performance chase by a lot of institutional investors who got left behind, and now the baton has been handed over to a blockbuster jobs release last week that shows that right now the jobs market continues to be very strong. We are glad to see that. Now, we want to highlight for you our next video is going to be a really special treat. We are going to be talking about budgeting. And no, that may put you to sleep or cause you to run the other way. This is one you're going to want to watch. This is a system that I have put together over the last 15 years that has really helped thousands of people with budgeting. And here's the key thing. This is a video that can impact anyone of any age, any income, etc. So we encourage you to forward it on to any friends when you get it, and let others know to subscribe to the channel here. They're not going to want to miss. We're going to be doing more videos on some of the educational topics in the back half of the year, in addition to our market updates videos. Lastly, if you are new to Centera, thank you for watching this video. You can always go to our website, Centera Capital, go to the contact page and reach out, and we can have a phone call. If you're not getting these kind of updates from your advisor, we'd love to talk to you. Thanks for watching and take care.